Picture this, a retirement plan that lets you contribute like a boss, lets you invest with autonomy, and secure your financial future with confidence. That's the solo 401k. Whether you're a gig worker, a consultant, a freelancer, or a one-man band man running your own business, the solo 401k is a retirement tool that you should consider when it comes to achieving your financial goals and future on your own terms. So you've made your money, now what? Well, welcome back to your virtual family office. My name is Teron Stokes, and here we talk about different ways to master your money and build a legacy. In this video, we'll be unraveling the layers of this powerful retirement tool. We'll be discussing the benefits, who qualifies, we'll be breaking down contribution limits, as well as I'll give you a real case and real life scenario as to one of the extreme values that comes with using a solo 401k. What is a solo 401k? Well, a solo 401k, also known as an individual 401k, is designed for businesses with no employees. In fact, the IRS says you can't contribute to a solo 401k if you have any full-time employees, though you can use the plan to cover both yourself and your spouse. You can participate in a solo 401k if you're among any of the following, and that's going to be 1, self-employed individuals who earn part of their income through self-employment business, owners of small business without employees except for themselves and their spouses. Solo 401k is similar to the corporate 401k. However, it comes with contribution limits that are almost 3 times as large as the corporate 401k. Setting up a solo 401k is pretty easy. All you need is what's called an employer identification number, EIN for short. And then you can go ahead and open up on most, or we'll say many, online brokers. The broker will provide a plan adoption agreement for you to complete, and then you'll go ahead and complete an application, at which point the account will be open for contributions, and then you can invest in things that the brokers have that are similar to what you could do with any other retirement plan. So if you want to take advantage of the contributions for this year, you'd have to make sure that you establish the plan and make the contribution before the end of the calendar year, that's December 31st. And then you can go ahead and add the profit sharing portion by the end of the tax year for that specific entity that you're filing on behalf of. If the plan gets rocking and you have $250,000 or more in the plan, you're going to have to file what's called a 5500 SF with the IRS. But those are things that your broker will walk you through. So don't feel nervous or anything like that. But that is something to keep aware of. Once you get to a point where there's $250,000 in that account, you are going to have to do a little bit more paperwork, but trust me, it's nowhere near as much paperwork you'd have to do for a corporate 401k. Nice thing about the solo 401k is you do have 2 tax advantages that you can take advantage of. Again, we talked about this numerous times in other videos about the traditional or the Roth, but a quick teaser to catch everybody up so that we're all on the same page. The traditional IRA is what we call a pre-tax contribution retirement vehicle, which means you're not paying any taxes on the contribution that you're putting into the account, but do expect to pay taxes once that money starts coming from the account and paying you later in retirement. The other side is the Roth, and the Roth is going to be your post-tax contribution. You are going to pay taxes on that money that goes into the Roth. However, you're not going to pay any taxes on any of the distributions that come out later in retirement. And that's a huge point when we're talking about these different retirement plans. Quick aside, those who did watch the traditional versus Roth video that I did earlier do know that the Roth IRA has a income limit to which you're no longer able to contribute to a Roth at all. Good thing though is a solo 401k, the Roth 401k does not have an income limit. The way you should go about thinking whether you're going to do the traditional solo 401k or the Roth 401k is really going to come down to what do you think your tax bracket is going to be in the future. If you're thinking that you're going to make more money in the future, therefore you're going to be in a higher tax bracket in the future, then it would make sense to go ahead and invest in the Roth, being that that money that you're now receiving, the distributions that you're now receiving, won't be taxed at that higher level. If for whatever reason you believe that you're not going to be in a higher tax bracket, maybe your earned income is lower than it is now, then you're going to go ahead and benefit from the traditional solo 401k, being that you were actually at a higher tax bracket while you were working, but once you got to retirement, you're in a lower tax bracket. So now when you're pulling the money from the account, you aren't going to be paying taxes at a high rate. Okay, so before moving on to how we vest and some of the other benefits that come, I do want to highlight this perk of the solo 401k. Outside of the typical investments that you can have in a solo 401k options, outside of what I briefly named before, like deeds, private loans, private businesses, limited liability companies. Like, these are things that you can invest in with a solo 401k. You can even take it one step further and invest in physical real estate. I did talk about that a little bit with the SEP IRA, being able to invest in physical real estate, but I also want to underpin that the solo 401k is also a vehicle that you can invest in real estate. And I'll do a separate video about the differences between the SEP IRA and the solo 401k when it comes to investing in physical real estate. But I do want to highlight here that the solo 401k, you can invest in developed land, residential property, foreclosures, commercial property. I mean, this retirement vehicle here is it's interesting. We talked about some of the investment benefits that you get from the solo 401k. Let's talk about some of the protections that you can receive, which are, I would say, pretty important as well. I mean, not necessarily as exciting, but definitely nonetheless important. Going back to bankruptcy protection, meaning that we are in a space where we're running a small business. As entrepreneurs, we all know the likelihood of success is not high in the first several years. Do understand, if you get to a point where you are cash flowing and you have enough money to sock away into your retirement plan, you do have protections if that business were to go south. The Bankruptcy Abuse Prevention and Consumer Protection Act of 2005. Again, I discussed this in a previous video with the SEP IRA, but understand that this is an unlimited amount. So again, if your business was not successful, but you were able to successfully put money into a solo 401k, it is protected. Moving on to another benefit, and that's going to be for estate planning purposes, because again, remember, the primary purpose of this channel is to master your money and build a legacy. And so being that the solo 401k, the SEP IRA, traditional, all these retirement accounts can bypass probate by making a beneficiary election when you're opening these accounts. This is something that your broker is going to ask as part of the application process. You're not gonna bypass it, but do make sure that you spend a good amount of time thinking about who you want those beneficiaries to be. Okay, so now we made it to the contributions. I went through the benefits, super exciting. Able to invest in physical real estate as well as other companies with this retirement vehicle while still benefiting from the tax advantages while we're doing this. Contribution limit for 2023, and again, this changes annually. So stick with the IRS website, like I said before, so you want to keep up with those different contribution limits as they change annually. But for 2023, you can contribute up to $66,000. So to understand the contribution limits for the solo 401k, you got to think of yourself as two people or two different categories. First of which is going to be the employer of yourself, and then also the employee of yourself. On the employee side, you can contribute up to $22,500 for 2023. And if you're 50 and older, then you can put an additional $7,500 into the account. And then shifting over to the employer side, you can contribute the difference between the $66,000 and the $22,000. But you do that based on the $330,000 compensation max that the IRS has laid out. So you can do 25% of that up to the difference between what the employee max contribution is and the $66,000, which is the max for everything. After your money's grown, well, how do we pull the money out? And so that's going to be very similar to what we've already talked about with the SEP IRA, as well as a traditional in the Roth. It's going to start becoming pretty repetitive, which is good. If you start feeling like this is repetitive, that means you're starting to get it, and that's fantastic. That's the goal here. And so that's going to be the 59.5 period, right? So anything before that, you're going to have what's called an early withdrawal penalty. But once you get past 59.5, then you can start making those withdrawals from the account. If you went the Roth route, you're going to be making those withdrawals tax-free. If you went the traditional route, now you're going to have to start to pay ordinary income tax on those withdrawals. Just something to keep account of. The solo 401k is a little bit different from the IRA in that the exceptions that you can have to that 10% penalty are called hardship exceptions. And I'm gonna go ahead and list out some of those. Are gonna be, you become disabled, you pass away, and your solo 401k is transferred over to your beneficiary, higher your funeral costs, higher education costs, uninsured medical expenses. I'm gonna put the list up there, but just understand that these instances that happen to you do allow you to get around the 10% penalty. If you don't fall within that hardship list, then you are gonna be hit with a 10% penalty in addition to the ordinary income tax that you're gonna be hit with for pulling that money out early. The solo 401k is a vehicle that for those of you who do not have employees but are business people, entrepreneurs, those who are really trying to make a difference in the world here, through commerce and capitalism, you have the opportunity to utilize a retirement vehicle that will give you the utmost flexibility, autonomy, and confidence necessary to achieve the financial future that you envision for yourself as well as your loved ones. I really want to thank you all for sticking with me. My name is Teron Stokes. This is your virtual family office. Here we focus on ways on how to master your money and build a legacy. Stay tuned for the next episode. We're going to be talking about the difference between the SEP IRA and the solo 401k as it relates to which vehicle is better to invest in physical real estate. Outside of that, I appreciate you, and we'll see you next time.